Hello everyone, we are members of Group 8. Our team includes Fang Feixin, Yuan Yixin, Wang Shaoyi, Liu Yiran, Chen Danghua, Chen Xiang. Today we discuss the financial statement analysis of Super Retail Group for the period 2020 to 2022, with the aim of analyzing financial performance, including assessing its profitability, asset and liability structure, in order to identify growth opportunities, understand potential market challenges, and accordingly formulate specific development strategies and financial planning recommendations. First, I will briefly introduce the Super Retail Group. Founded in the 1970s, it initially sold only imported battery chargers and auto parts. Over the past 6 decades, through the key expansions and acquisitions such as Race Outdoors in 2010 and the integration of Reebok Sport and Amart Sports in 2011. The group has become a global retail powerhouse with 4 sub-brands. Supercheap Auto, established in 1972, is a leading automotive parts retailer in Australia and New Zealand. Reebok is a leading Australian sporting goods retailer. BCF specializes in outdoor activities products. MacTac is an outdoor clothing and equipment company. Its products range covers automotive, sports, outdoors, and other fields, showing as its market diversity. Next, we will provide a detailed analysis of Group's financial performance for the financial years 2020 to 2022. Focusing on profitability, asset efficiency, liquidity, and capital structure.
Profitability was increased by 14.95% in 2021 compared to 2020, but decreased by 7.96% in 2022. The volatility was mainly caused by trend in net profit, which increased by $119 million from 2020 to 2021, but decreased by $59.8 million in 2022. Impacted by COVID-19, the Australia fire and supply chain disruption, return on asset rose from 4.84% in 2020 to 10.46% in 2021, but fell to 8.17% in 2022. This reflects the growth of the group's total asset and adoption of AASB's lease number system. Gross margin remained in the range of 13.5% to 15% over the 3-year period, showing product value and stable gross margin trend despite increased supply chain costs and promotional activity due to COVID-19. Net profit margin increased significantly between 2020 and 2021, but declined slightly in 2022, reflecting the impact of increased costs in net profit. Asset turnover was stable at about 1.2, indicating consistency in asset management and utilization. Overall, the Super Retail Group has successfully met the challenges posed by COVID-19 and natural disaster by adjusting its sales strategy, strengthening its online presence, and effective cost management, and achieve stable profitability amid fluctuation in revenues and profit. Asset efficiency between 2020 and 2022, the number of days of inventory turnover in Super Retail Group has trended significantly. The number of the days of inventory turnover in 2022 increased by more than 20 days compared to the previous 2 years, due to the significant increase in inventory from 2021, which increased by 38.71% and 40.82% respectively, while the corresponding increase in cost of sale was only 15.57% and 5.18%. This inventory increase is in response to global supply chain disruption caused by the COVID outbreak, while maintaining sales performance and meeting the recovery in consumer demand. Inventory levels are expected to normalize gradually as the impacts of the pandemic abate. At the same time, the turnover days of account receivable also fluctuate, decreasing by 40.17 days in 2021 and increasing by 26.84 1.18 day in 2022. This was mainly due to an increase in trade receivable and other receivable. In summary, the overall operating cycle of the group in 2022 is significantly extended, showing a decline in capital recovery capacity in the face of macroeconomic challenges, including geopolitical conflict, COVID-19, rising commodity price, interest rate hikes, rate pressure, and global inflation. The group has maintained a sound financial position to cope with their risk.
Let me continue with the financial liquidity section of the group. From 2020 to 2022, Super Retail Group's financial position improved, with current ratio fluctuations. The participation in a supply chain finance program reduced payables, but a decrease in a quick ratio indicated weaker short-term solvency. Next, we will explain the capital structure analysis part. The debt ratio dropped from 64.28% in 2020 to 55.85% in 2022, reflecting stable financial growth and strong cash flow. Following COVID-19, the group achieved significant growth in online sales and the Super Cheap Auto brand by adjusting its retail strategy and enhancing its digital capabilities. In addition, the group had no outstanding notes at the end of 2022, after repaying its notes and canceling 100 million notes from ANZ. The debt-to-equity ratio decreased from 1.8 in 2020 to 1.26 in 2022. At the same time, the equity ratio improved, reaching 44.15% in 2022. Close to the ideal 15%, showing strong ownership, equity, and reduced debt reliance. This is further evident in the debt coverage ratio, which peaked in 2021 at 24%, indicating a strong ability to cover finance costs. The interest coverage ratio also increased significantly to 10.21 in 2021. And decreased to 7.93 in 2022. But the company has maintained a strong repayment capacity. These trends reflected solid financial performance, with a dividend of 17 cents per share for 2022 and a payout ratio of 65%. Overall, despite challenges like academics, disasters, conflicts, and economic downturns, the group remained stable and profitable. With Australia and New Zealand's economic recovery, its performance and solvency will further improve.
Let's move to the next part, cash flow statement analysis and interpretation. We will delve into a thorough analysis of our cash flow from 2020 to 2022, covering both inflow and outflow structures, ratios, and profit quality. We've seen a consistent increase in cash flow from operating activities over these years, indicating strong operational performance. However, there is a noticeable decline in the inflow-outflow ratio, though it remains above 1. This suggests our operating activities are still generating good cash flow, but we need to be mindful of the downward trend. On the outflow side, a significant portion is directed towards operating costs, primarily payment to suppliers and employees. Notably, in 2020, there was a higher cash outflow in financing activities due to loan repayments. The minimum outflow from investment activities is worth mentioning, showing prudent external investment in expanding operation and upgrading our infrastructures. Our profit quality analysis reveals that the net cash flow from operating activities has been consistently positive, though it dropped in 2022 due to increased expenses and higher tax payment. In contrast, the cash flow from investment activities has been negative, aligning with our strategic expansions in 2022, such as opening new stores and increasing inventory to mitigate supply chain disruptions. The navigate cash flow from financing activities reflects our strategy to repay debts, enhancing our financial stability. However, this has also led to an increased cash flow deficit in 2022, mainly due to a decrease in operating cash flow and heightened supplier payments. In conclusion, Group demonstrates a stable and healthy financial position with effective debt management. Looking forward, we are optimistic about our robust profitability and long-term growth as we continue to navigate through post-COVID recovery and global supply chain challenges.
Hello everyone, now I will give you some more information about our company. Other relevant information in 2022, we actively participated in several charitable initiatives. During the falls in Southeast Queensland and Northern New South Wales, we donated $115,000 to relief efforts and provided sports equipment to local clubs. We also launched the Super Cheap Auto Charity fundraising program, partnering with organizations like Beyond Blue, Heart Case, and the Australia Road Safety Foundation. Rebel supported Mental Health Week by donating $500,000 to Lifeline, and BCF partnered with Old Fish, focusing on Australia fisheries conservation. The Magpie Philanthropy Fund supported various non-profit organizations, emphasizing environmental education and engineers community projects. However, 2022 also brought global challenges. Supply chain disruption, geopolitical conflicts, and inflation impacted our operations. We faced increased costs and had to adapt our supply chain management. The COVID-19 pandemic, starting from 2020, caused production interruption and demand fluctuation, accelerating our digital transformation and emphasizing the need for supply chain diversification.
Summary and conclusion. Current financial situation. Profitability. SRG has maintained stable profitability from 2020 to 2022, adapting well to challenges through flexible strategies. Asset efficiency. Due to effective asset management, SRG has shown good performance over the past 3 years. Liquidity. SRG experienced fluctuations in short-term debts, surprising with weaker short-term solvency after including inventories. Potential risks. Capital structure. SRG has maintained a reasonable recovery ratio in the context of easing inflationary pressure and steady macroeconomic recovery, and its debt solvency is expected to improve. Inventory management. An increase in inventory may bring warehousing cost risks. Cash flow management. Reduction in cash and cash equivalents could impact SRG's ability to meet short-term obligations and invest in growing opportunities. Recommendations. Enhance inventory management. SRG should optimize inventory levels to match actual demand and avoid excessive fund occupation. Improve cash flow. Improving cash flow management is crucial to maintain liquidity for operations and investments. Supply chain diversification. Diversifying supply chain resources can mitigate risks from supply chain disruptions. Digital and e-commerce investments. Investing in digital capability and e-commerce platforms can open new markets and sales channels, reducing reliance on offline stores. Monitor market trends. Keeping a close eye on market trends and macroeconomic indicators will announce timely adjustments to business strategies. Thank you. That's our presentation.